Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shana Smith. Let's get you up to speed on the market action. 1 hour left to go in the trading day, and we are seeing just the Dow in the green right now, up 59 points. The S&P 500 up down 12, I should say, and the Nasdaq down more than 100 points. The Nasdaq, the biggest loser on the day, down for a fourth straight day. And in terms of sectors, tech seeing the biggest declines on the day. We also have been watching Treasury yields all pulling back today on the back of some economic data that came through this morning. Fewer than expected jobless claims, as well as an uptick in labor costs, all adding to some jitters among investors that the Fed may not be done with its rate hiking cycle just yet. You see the 10-year yield pulling back right now at 4.27%. But of course, Shauna, the big corporate story of the day, Apple.
It certainly is Apple here, Akiko, and take a look at the stock because shares tumbling today after the company looks like it's getting caught in the crosshairs of the geopolitical battle between the U.S. and China. It's down for a second day in a row today, off just about 3%, but the 2 days of losses, $200 billion is said to be wiped off the value of the tech giant at the close of today. Now lower for a second day, this time on reports that China is planning to expand its ban on iPhones to government-backed agencies and state companies. Now the move lower in Apple is having a widespread effect on the markets. A number of the larger tech giants falling today as well. We want to bring in Amy Kong, partner at Corient Wealth Management. Amy, it's good to see you. So certainly some concern here amongst investors about what exactly this could mean for Apple, but this move lower once again today. Do you think the concern here justifies this massive drop that we've seen in the stock?
Hi, ladies. Nice seeing you both again. I'm certain that the headlines is concerning. We're watching it very closely ourselves. But I think the shortfall that we're seeing today and in recent days is justifiable. What we're seeing from the China headline seems to be, from our standpoint, just a question on national security at the moment, and not necessarily a ban of foreign companies doing business in China. Obviously, we're watching that very carefully because the risk of such a headline could be a potential signal that Chinese citizens should be using more domestic technology as opposed to foreign technology. But we're not quite there yet. We're still holding on to the stock. We do think that it is a reciprocation of some of the laws that we've seen in the U.S., banning TikTok or using Huawei technologies as an example. And so again, from our standpoint, it seems to be more, again, national security at the moment. We're not yet throwing in the towel on Apple. We do think, though, that this is worth watching as China is about 18% of Apple's revenue.
So, Amy, if it is just about national security, it's largely contained. What do you make of the move on Apple and then kind of the ripple effect that we have seen in tech overall today?
Yeah, it's a great question, Akiko. And I actually think that it is, from our standpoint, a little bit of a relief to see some of the tech companies sell off a little bit. One of the things that we've been more concerned about going into this rally we've seen all year is the valuation levels of not just the FANG stocks, but again, some of these semiconductor companies, NVIDIA, et cetera, that obviously have been benefiting from AI euphoria and just a tech rebound in general. And so the fact that they've been selling off a little bit, to us, it's very normal. And we actually are somewhat relieved that the valuation story is quote unquote not as frothy as from some weeks before.
So, Amy, are you seeing investment opportunities here within tech? And I guess where are you? I know you're saying you're advising investors to hold Apple, but where else are you seeing a reason to buy at these levels?
We're actually not quite recommending investors to put dollars back into tech just yet. We've had a full position going into this rally. And so what we've been advising is really to stay put. While we have seen some of the froth removed from this sector, we're not quite at the point where we're saying that the market is attractive enough from a price to earnings perspective, as an example, to, again, add more dollars to the market. So we're holding steady at the moment.
Amy, let's look at where we are in terms of Treasury yields. A huge pullback that we have seen today in the session on the back of economic data we got out this morning. We saw the weekly jobless claims, fewer than expected on that front. What's your read on that? I mean, this is a weekly data point that we get. We don't want to make too much of it. But the fact that we are seeing such significant moves in Treasuries, what does that tell you about where sentiment is right now?
Sure. This morning's jobless claims number is, to your point, one data point, and I don't want to read too much into it. What we're trying to do there is back up a little bit and think about the trend line that we've been seeing for some weeks now. And right now, from our standpoint, that trend line is pretty steady. Unemployment claims has been averaging about 240,000 per week, and we have not really seen any big deviations from that. And again, if we start to see deviations from that, that obviously will give us more data points in terms of the economy and the direction of the economy. Treasury yields, to your point, backing up a little bit, I think it is, obviously a move that there is now more macro headlines into the mix, geopolitical headlines as Apple and China and such. And so I think it is just a reflection that we've had a really, really strong rally, 18+% as of the end of August. It is not surprising to see, again, the bears come back into the story and suggest that, hey, listen, it's not always, fun and sun. There could be some risk. And I think those risks are starting to, again, be a little bit more apparent today.
Amy, what do you think that risk looks like? And at least up until now, the base case from the street has certainly been, it seems like at least recently, a soft landing. Is that your base case too?
I think for the remainder of 2023, we believe that the probability of a recession is lower. The data continues to be very conflicting to us. We're seeing that leading economic indicators should suggest a recession, but the consumer and companies' corporate profits rather, continues to surprise us to the upside. We do continue to see signals that things are slowing down, and we can, certainly point to those signals, whether it is in the jobs market or just the general business activity. And so we do not think a recession will happen this year, but I certainly don't want to be in the camp that we're going to be in a soft landing next year. Again, the data points to our perspective is softening, and we want to be very careful watching that over the next couple of quarters.
Let's talk about one area that's raised some concerns about reacceleration of inflation, and that is in oil. We have seen those prices creeping back up, production cuts being extended from Saudi Arabia, Russian production cuts taking effect as well. And then, of course, there's the inventory levels that are happening domestically. How are you playing the energy space right now, just given how big of a pullback we've seen when you compare it to last year's levels?
Yeah, I hear you. I think energy continues to be an area that could surprise now to the upside, given some of those cuts that you've talked about. The bigger questions for us is how sustainable that becomes over the next couple of quarters, because the more sustainable it becomes, the more of an impact it could have on corporate profits going into the next several quarters. And of course, it can complicate this whole soft landing situation that the market has been baking in. Don't forget, when you think about the CPI numbers that the Fed focuses on, energy as a category is down, 12, 13% on a year-over-year basis. And if we start to see that pick up again, we wouldn't be surprised to see inflation potentially picking up a little bit or just not slowing down as much. And that obviously will throw a wrench into the Fed story of potentially pausing for the time being.
It could be problematic there for the Fed. Amy Kong, partner at Corian. Thanks.
Thank you.
Well, let's move on to the UAW strike now, with General Motors making an offer to the UAW just a week before their current contract is set to expire. Praz Subramanian is here with the details. Praz, what are the numbers? What are they offered?
Hey, yeah, GM, the latest to submit a proposal to the UAW following Ford's move last week. So big picture stuff here. So for all employees, more paid holidays and a $5,500 ratification bonus. Now, for temp and in-progress or tiered workers, they're going to get a big 56% wage increase over time for entry-level workers and a 20% for temp workers. Now, for most workers, big picture here, a 10% increase in wages, 3% lump sum payments, a one-time $6,000 inflation payment, and then a $5,000 inflation protection bonus over the life of the UAW contract. So it's a start, but not really what the union has initially demanded. Want to highlight Ford real quick right here. So today they announced a wage hikes for about 8,000 UAW employees of around $9,000. This is around 14% of the workforce. This is a bump up for some of the workers to get to the top of the wage scale here. And this is part of the 2019 UAW agreement, not the new one. It's part of the old one that's still kind of ongoing right now.
So, Praz, the fact that this is not exactly what the union wants, it still seems that the two sides are very far apart on this.
Yeah, Shauna, for sure. I mean, the UAW wants something around a 40% pay hike. They want to end tiered compensation. They want cost of living increases, and they also want a defined pension plan, among other bonuses. Now, so union leadership is talking a tough game, ready to strike if needed. Here's UAW President Shawn Fain talking to the AP yesterday about this.
At the end of the day, if we don't have agreements with the three of them by September 14th, then there will be action. We're willing to listen when they want to get real and talk about our workers' issues and the economic realism that our workers have been living with for the last 16 years. And so when they're ready to get serious, we're ready.
So to be clear, the union doesn't have to strike without an agreement. They can also strike at certain automakers while negotiating with the other two. So it all depends on the situation here.
And Praz, we have seen this in other industries. You've got the threat of a strike, and the strike doesn't actually take hold, but the agreement leads to higher costs, higher, input for these companies. What does it ultimately mean for the consumer? I mean, and there's been a number of estimates out there that suggest that this is going to be the higher costs that may come with a negotiation. An agreement would be passed down to consumers.
Well, right about now, I think it's around 5 to 6% of the car cost is due to labor. So you might see a bump up there with the passed on costs of higher labor costs. But, even in the case that if there is a strike, for instance, right, if there is a strike, I think consumers are sort of okay here from a price point of view. Most automakers have 90 days of supply. So you're not going to see that much of a change in price unless this drags on, in which case you might see inventory come down, premiums being paid for new cars. And then maybe shoppers may cross shop and go to other automakers that don't use union workers. But we saw a report out today, Akiko, about how if inventory goes down for new cars, you might see used cars go up, and that actually would increase insurance prices because insurance costs are more for used cars. So you might see some pain at the insurance payment area, but not so much yet, just quite yet. But we'll see what this deal kind of shapes up to be before we can see what consumers will pay for.
Okay, just 1 week to go until that September 14th deadline. Pras, thanks so much for that.
All right, just about 45 minutes to go until the closing bell. And taking a look at the markets, this market check sponsored by Tasty Trade. You're still looking at the Dow holding on to gains up just about 40 points, but the losses there in Apple, with Apple stock off just about 3%. It's the worst performer in the Dow today. Worry there just about the reports that China could be looking to expand its ban on iPhones. So some of the state-backed firms, that's weighing on sentiment today. We're seeing that reflected in the Nasdaq, with the Nasdaq off just nearly 1%. We also want to take a look at the VIX as this worry creeps back into the market. Also, what the Fed is going to do at its next policy meeting. We're seeing the VIX tick up just a bit at 1465. So some worry there just about higher rates and what that could do to equities.
Well, we are just getting started here on Yahoo Finance Live. Coming up, we head back out to the 2023 Goldman Sachs Communacopia and Tech Conference as Brian Sazzi catches up with the CEO of Mattel to discuss, yes, the Barbie movie and the Barbie craze that's come along with it, how that's helping boost sales for the company. Plus, mortgage rates lower this week, but still remaining above 7%. We'll break down what that means for the housing market later in the hour. And what's better than knowing what's happening now? Knowing what's next. We're going to preview what to expect from Yahoo Finance's new video series Next, debuting tomorrow. All that and much more when Yahoo Finance returns.
Coming up, you know Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's Next.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance's coverage of the Goldman Sachs Communacopia Conference in San Francisco. We've been talking all week long about AI, the future of media. Now we're going to talk a little bit about both. We have some toys and we have some media. Mattel Chairman and CEO Anand Krais. Anand, where's Will Ferrell's behind you somewhere, right? I'm looking for him. No?
Great to see you, Brian. Thank you for having me.
So what is next on the Barbie front? We're starting to see every week the gross theater receipts continue to increase. You're approaching $2 billion. What is next for this franchise?
Well, we couldn't be more excited about the way the movie played out, to resounding success, a real execution of Greta Gerwig's vision. And what we're seeing coming out of it are 3 things. It's the strength and cultural resonance of our brands, is our ability to attract, collaborate, and partner with top creative talent, and our ability to promote and create a cultural event of this movie, leveraging our commercial capabilities in partnership with Warner Brothers, who did a terrific job marketing the movie. So it's been a real combination driven by strong brand and great execution, both creatively and commercially.
Your CFO gave a presentation earlier this morning, I think for the first time shared some numbers on how much Mattel may make from this movie. Can you share some of those numbers, and what does it mean for the future financial performance of the company?
Yes, we did talk about our revenue, gross billing this year to go up by about $125 million from the direct movie participation, toys, and consumer products directly related to the movie, not other Barbie product, at a 60% operating income margin. So about $75 million operating income contribution directly related to the movie in 2023.
Is that higher than your expectations? Because from the outside looking in, that's a huge number. In many respects, Anand, that's a number that you didn't have last year on the financial statements.
Well, we did not expect the movie to be as successful, so it is more than we assumed entering the year. And we expect that in future years, there'll be continued benefit from the movie. This is about long-term franchise management. It's not just about the quarter or the year. And it's the thing that we've always talked about, you and me. This was the approach. It was never about just trying to sell more toys. It was about creating a cultural event, creating a societal moment. And we believe the benefit will carry forward for years to come.
We've talked a lot throughout the years, and this is the first time I've heard you mention franchise management. What does that mean as it pertains to now this cultural juggernaut that you've created? Of course, the Barbie brand has been there for decades, but now you have the movie, you have the content component. How do you manage this?
We started our journey as a toy company, as a toy manufacturing company. We evolved to be an IP company that manages franchises. And the biggest change in how we approach our business is to realize that people who buy our products are not just consumers, they are fans. And once you have a lot of fans, it's an audience. And when you realize that you have an audience, it changes the conversation and the opportunity for you to continue to grow your business. And given that we own one of the strongest portfolios in children and family entertainment franchises in the world, this creates very unique and exciting opportunity for us to grow outside of the toy aisle into highly accretive business verticals driven by big brands and big franchises, which we own. And the Barbie movie, we see as a template, as an example, in terms of how we approach franchise management, and expect more to come.
You have a portfolio of really amazing toy brands that all of us, in many respects, have grown up using. How do you take this playbook and apply it to some of these brands? What will we see from a Mattel over the next 24 months?
Our brands are very much timely as much as they are timeless. And we've been doing a lot of work around infusing cultural relevance and societal awareness for what we do with a very strong purpose behind our brand. So it's more than a toy. What we create is more than a play system. It's a holistic approach to engage with your fans across multiple levels. And the opportunity for us is not just film, it's also television, it's video games, it's location-based entertainment, it's musicals, it's whatever medium is driven by big franchises and big brands. In today's world, this is what it's all about. Big brands, big franchises that elevate and rise above a crowded marketplace. And we believe we're at the beginning of a very exciting part of our journey.
Look, it's going to be hard to create another nearly $2 billion movie. It just doesn't happen very often. But within the portfolios in the portfolio brands you own, what's the brand you're really focused on that you're going to run this playbook with next?
Yeah, we're not saying every movie that we make will be as successful, but it will be the same approach, the same methodology, and the same creative take that we are looking to apply. There's the Hot Wheels movie that we're developing with J.J. Abrams. There's a Matchbox movie with Skydance, which produced Mission Impossible and Top Gun. There's a movie we're developing with Vin Diesel for Rock'em Sock'em Robots. Polly Pocket with Lena Dunham and Lily Collins. And Major Matt Mason with Tom Hanks, written by Akiva Goldsman. So these are just a few examples of some of the projects that we're developing, and you can see, given the quality and strength and proven track record of our partners, we believe we have a real shot at creating exciting projects that will appeal to global audiences. And what we saw in the Barbie movie is that the picture appealed not just to the core buyers of Barbie toys, Barbie product. This was a much broader approach to global audiences across different demographics, men and women, different ages, different generations. And everyone found something that talked to them and touched them at an emotional level. And the credit goes to the incredible execution of this project by Greta Gerwig, who had such a vision. And of course, Margot Robbie, as a producer and a lead actor, Ryan Gosling, and of course the soundtrack that was a key part of the holistic experience. All of it created something very special that we're very proud of.
This didn't happen overnight, but my sense has been that you saw the potential of this happening many years ago when you took over at Mattel. From a leadership perspective, how did you identify that? And then how do you ultimately go about bringing that to life?
Yeah, this journey has been long in the making, started about 5 years ago. And from the very beginning, the approach was to create something that was not conventional, something that was not traditional. And the term cultural event is what we said back in the day. It was never about trying to make a movie, or for that matter, make a movie in order to sell toys. The focus was to create a quality content that people will want to watch. And we know that if we do that, and if we do that well, good things will happen. And we will sell a lot of toys. So it's not that we didn't want to sell toys, but the mandate and the approach and the relationship and the engagement with the creatives that partnered with us was to focus on making a great movie and not think about selling toys. And what we see now, of course, we have a great movie. We see the success at the box office, and we're also starting to see success on the toy side of the company, with POS for the company year to date up, Barbie gaining momentum, and overall we see good, very exciting opportunity for us to continue to gain share.
Seemingly every day over the past 3 months, I've read another story about the Barbie movie, something new happening. but also you've been front and center in a lot of these stories, Anand, as you should be, because you brought this to life, this cultural event. How have you stayed grounded, and how are you looking to stay grounded over the next few months when you have all these publications writing about you, telling you how successful you are? How do you just stay focused with all of this frenzy around yourself?
Well, this very much has been a team effort. It's been a journey with a lot of people that participated and made it all happen. And I couldn't be more proud of the team and everything we've done collectively. For this to be successful, for this movie to be where it is today, it took a lot of effort. And I'm grateful for everyone's support and involvement. And we really do see it as a beginning of a new chapter. This is not a one-off movie. It's not a one-off project. This has been the strategy. And you followed our story, and you know that we've been consistently made progress in building and driving our IP strategy to reach this point. But it's not the moment we've been waiting to arrive and we're done by any stretch. This is really another step in the journey. We see it as a template. We see it as an example. As I said before, this is the approach. And we look to replicate that approach in terms of leveraging our brands that have been foundational in this case specifically. Barbie, it's the Barbie movie, working with top talent that have a clear vision and are the best in what they do, which we have done in this movie as well. And of course, commercializing and executing at the marketing level and creating demand in a marketplace that became a cultural phenomenon. And so this has been an exciting journey, and we're still very much at the early stage of it.
Thanks for making a little time for little old me, Anand. I appreciate it. I know you're the big star now, but I appreciate it. Thanks for always giving time to Yahoo Finance. It's been fun to follow this journey. I mean, hat tip to you and your team. Anand Krize, Chairman and CEO of Mattel. Shona, back to you in New York. I know you're a big fan of the Barbie movie.
I am a big fan of the Barbie movie. We've been talking about it for over a year. So, of course, our thanks to you, Saz, all the great interviews out there, and Mattel CEO Anand Krize as well. All right, well, Apple shares under pressure today, poised to shed $200 billion in market value in just 2 days. Jared Blickery is here with a closer look at the moves in Apple. Jared, losses of just about 3%.
Yes, that's only today. You take a look at the last 2 days, and we're down about 6.5%. Haven't seen a slide like that since November of last year. But I want to talk about what we should expect going forward. First of all, let me just pull up a candlestick chart so we can review the price action. Really negative price action about a month ago. We dropped below the 50-day moving average, not shown here, came up, kissed it, actually went a little bit above it, and now we are just selling off strongly. Those two big down candles. Now we are testing levels basically from last June, and we'll have to see what happens from here. But I did compile a seasonality chart. What happens to Apple each month of the year? Well, we have over 40 years of data here from 1981 to 2022, and I have the average and the median. What really stands out is we have August, that's a big up month here, and then September. September is a big down month. What usually happens in September? Well, next Tuesday we have that big iPhone launch, and this is something that's been happening for about a decade now. Even before the iPhone was launched in 2007, though, September was a bad month. So interesting to see how that's developed. But usually we do see a kind of glide path higher in August and then a sell-off from the announcement. But I think it's notable that we've already sold off in August. What it portends for the future, not sure here, but I don't think we should necessarily expect that big rebound in October. Is there something structurally wrong with Apple here? Well, I would note, and it's not a disaster yet, but 3 quarters of declining year-over-year revenue. This is something that you don't want to see with a big technology company, because I've seen Sanford Bernstein recently, only in the last few days, compare Apple to Big Blue. This is a Big Blue chart going back all the way to the 1970s. And from 1997 to 2012, Big Blue had a huge run up here that also included a lot of volatility in the tech bubble. But after that, they faced declining revenues. And I think they went something like 20 quarters of declining revenues back to back, something that had never happened before. So kind of a cautionary tale here. We do want to see consumers increase their investments and increase their purchases in Apple products such that they maintain or at least exceed that revenue growth that they've had in prior years, but that remains to be seen. So going to be interesting to see what happens come next Tuesday. Is it going to be a further sell the news event, or might we see the the opposite? Might investors just buy it? We'll have to see.
We will see, but there's a heck of a lot of excitement around this potential new phone. As always, that's right. That's good to point out. Hey, Jared, thanks. Well, coming up, mortgage rates edging slightly lower this week, but still above 7% for the fourth week in a row. We're going to break down what this means for the housing market when we come back.
Did Dan Howley go all the way to Seoul for some light shopping? He's no doubt a tech aficionado and the citizen of the world. You need to know what he's up to. We'll find out when Yahoo Finance is next.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is What's Next with Samsung.
So you can put it in the water.
That's pretty gnarly.
Water.
This is the heart and soul of Astrobotic. This is where we build our landers up to go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series next.
Mortgage rates retreated slightly this week, but they are still above 7% for the fourth consecutive week. That's still keeping home buyers and sellers away from the housing market. Here with the numbers and a look inside the housing market, let's bring in Yahoo Finance's housing reporter, Rebecca Chen. Rebecca, still elevated, but I guess we'll take any relief we can get.
That's right, Akiko. So mortgage rate did drop slightly this week, but it is still hovering above 7%. And that, if you ask most home buyers, that is still too high for them. So average 30-year rate was about 7.12% according to Freddie Mac. And the last time that mortgage rates stayed above 7% for 4 straight weeks was back in 2002, which is more than 20 years ago. So what we're really seeing in the market is a dramatic slowdown from both the seller and the buyer side of the market. So let's say for instance, if we're looking at the seller side, the listing number of new listings this week was about 10% less than what they had last year, according to Redfin. And if we look on the buyer side, the mortgage application also dropped another 3% this week. And we're actually now at the lowest point of the volume of mortgage applications since December of 1996, which is about 30 years ago. So this is according to Mortgage Banker Association. So as you can tell, there is really a standstill between the buyers and the seller in the housing market right now because of the interest rate.
So Rebecca, what does this mean then for the housing market going forward? Is this situation going to improve for home buyers, potential home buyers, or even sellers anytime soon?
You know, the numbers that we've been seeing is that Americans are not loving the housing market right now. And in fact, about 4 in 5 Americans think right now is a bad time to buy a house. And that has really been some of the highest number that we've seen in recent years about this Americans' pessimism about the housing market. And if we were to look a little bit into the future for the next 12 months, not also 4 in 5 Americans believe that mortgage rates will either stay the same or go even higher within the next 12 months. So really, for the future, we're not really seeing any indication that the real estate market is going to ease up anytime soon.
Okay, still a gloomy outlook in the space. Rebecca Chen, as always, thanks so much for that.
Security services company ADT announcing the sale of its commercial business last month for $1.6 billion. Now, the deal with private equity firm GTCR is expected to close late this year. For that and much, much more, we want to head back out to Brian Sazzi. He's live from Goldman Sachs' tech conference in San Francisco alongside ADT CEO Jim DeVries. Brian.
Hey, Shauna, long time no see. Jim, good to see you here. 1 year ago, we were talking about the future of ADT. Since then, you have sold this commercial business like Shauna just mentioned. What's next for your company?
Well, I tell you, first, thanks for having me, Brian. Thrilled to be here. Big opportunity for us with selling the commercial business. We got a great price for it, a multiple arbitrage. We're using all of the dollars to pay down debt and sort of accelerate our deleveraging. We went from a 3.7 down to a 3.3. Feel really good about that. We have a path to 3, and now we'll be more focused on the residential market and our sweet spot in residential home security.
The commercial business, is that just ADT signaling we don't want exposure to commercial real estate and whatever might happen with that because of higher interest rates over the next couple of years?
Not so much. We had inbounds over the course of the last couple of years about this business. The implied multiple for ADT right now is about a 6x, and we traded the business, the commercial business, for an 11. So we had a big multiple arbitrage, something in the neighborhood of $750 million of arbitrage. From a cash flow perspective, it's about a wash. The interest expense savings that we realize from paying off about $1.5 billion of debt is about what the business would have provided. And then in these markets especially, it's important to delever. And we've heard that from our investors, we've heard that from prospective investors, and we think it opens more doors for us to talk about our story.
What's the health of your customer base from a residential perspective?
Very good. We measure retention very closely. It's one of our key metrics, and we're at 12.5% attrition on a trailing 12-month basis. Never in our history have we been as low as 12.5%. It's wind aided a bit because relocations are down. When relocations are down, our base is stickier. Fewer relocations is a headwind from a gross ad perspective, but from a customer retention perspective, it helps us a great deal. And so we're at 12.5% attrition, never been better.
Do you survey your customers on, I'm curious on why they haven't cut their alarm bill? We talk to a lot of different consumers and businesses. People are cutting back on clothing. They're cutting back
on various lines of food. They're trading down on types of food, but they're not cutting their alarm bill.
They are not. And generally speaking, broadly, we have two kinds of customers. A customer that is security-centric, that relies on their system for pure peace of mind. And that's not a service that customer is interested in eliminating. They derive a great deal of comfort from the security that the system provides. The second kind of customer is a customer that uses our system much more for smart home, to make their home more helpful. They have cameras, they might have mesh Wi-Fi, lights, locks, are integrated into the system, and it becomes how they interact with their home. And because they derive convenience and a more helpful home because of the system, that's not something that they're willing to do without.
It is fun to try to open my door lock from my phone inside from my car. I know I don't have an ADT. We'll take that off camera, though. Well, it is what it is. Where are you at with your Google partnership? What is next from there?
Google's been a great partner for us. They're an equity owner. 3 years ago, they purchased about $450 million of stock. They own about 6% of our company. They've been terrific. We're going to market as ADT plus Google. So it helps our brand as ADT be a little more tech forward, a little more contemporary, and their products are fantastic. I've shared this a number of times. The year before the Google deal, we were selling white label equipment, and our average installation was about $700. Now we're selling Google branded hardware, cameras, video doorbell, Nest thermostat. Our average installation revenue is $1,450. They've been a really good partner for us.
Do you have any new products hitting from that deal soon?
We have some new products that we're developing. We're not ready for prime time quite yet, but first quarter, maybe second quarter, we'll have some products start to that we'll be ready to unveil.
Does that change? Will it change how we interact with an ADT now, or does it give a glimpse into the future of the smart home?
It does. One of the things, I'll frame it up a little bit for you. One of the things that we're excited about is leveraging the analytics, leveraging the AI available to us via the Google partnership to essentially use your cameras as a digital assistant of sorts in the home. And so you can query to understand, is anybody in the house? Is my kid home from school yet? Are any of my children playing by the pool? Are any of my children in the pool? And get proactive notification of that event in the house. And it just makes for the system to be much smarter, much more helpful to give more convenience and information to our customers.
That's wild stuff.
It's really cool. It's really cool. I think it will result in a stickier customer for us. And there's all kinds of use cases, all kinds of applications that you can build off of that to create great customer experiences.
Before I let you go, just in terms of the stock price, are you surprised it hasn't maybe reacted to some of these big moves that you sold a business for well over $1 billion. You have a deal with Google. You struck a deal, I think, a couple weeks before this conference last year with State Farm. I mean, you've made all the moves. What else does the market need to see from ADT?
We've always been a show-me stock. We'll continue to be a show-me stock. One of the issues that we continually faced was the leverage. When we were close to 4.0 on a leverage ratio, we were getting screened out pretty consistently. Now that we're at 3.3 with line of sight to 3, I think it opens the aperture for us. We're excited about our future. As you know, Brian, it's about getting new investors, is about farming, not hunting. It takes a little bit of time, and we're going to go out there, do what we do, continue to deliver results, and eventually the stock's going to get there.
Fair enough. We'll leave it there. ADT CEO Jim DeVries, always good to see you, and can you post on that smart home stuff? It sounds
it's
cool.
It's a deal. Thanks.
All right, guys, back to you.
Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Howley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finance's next. The debate over student loans comes to a head as federal payments are set to resume October 1st. Many of Americans, millions in fact, are about to possibly have their finances turned upside down. So, where do we go from here? Yahoo Finance is here to address some key questions surrounding the student loan crisis, like what loans qualify for forgiveness or even cancellation? What tools does the Biden administration have in its back pocket to address student loans? How will payments impact the economy? And how should you be rebalancing your budget for this new expense? And finally, are student loans worth it? Join us for our special Student Loans, Crisis or Crucial, right here, starting Monday, September 11th on Yahoo Finance.
Well, Apple is getting hit by a reported crackdown on iPhone use in China. The Wall Street Journal reporting Beijing is implementing a ban for government employees. And now Bloomberg reporting the ban could expand beyond government workers. This all comes as Chinese smartphone maker Huawei unveils its newest smartphone. And a teardown reportedly shows that the phone's chip is more advanced than initially thought. Let's bring in Riva Gojan, Rhodium Group Director. Riva, can we first talk about the timing of all of this in terms of these reported bans that could be coming? We had the Huawei release of the Mate 60 last week. We had the visit by the Commerce Secretary. Is all this connected, or are we reading too much into it?
Well, I don't know how closely related the Commerce Secretary's visit would be to this. There was certainly an attempt by both China and the U.S. to put a very positive spin around what legitimately transpired through those meetings during Secretary Raimondo's visit. But when we look at the timing of the Huawei announcements and what was revealed in the teardown, naturally, China has intent to showcase when it has technological breakthroughs. There's some question over to what degree does this actually represent a breakthrough and an ability for heavily sanctioned Chinese firms like Huawei to circumvent U.S. export controls and sanctions. But at the same time, every time we see a revelation like this, it also very quickly leads to a tightened U.S. policy response. And honestly, it's deja vu. If you remember last year in August, there was a teardown, and that showed that SMIC was producing a 7-nanometer chip that got a lot of attention in Washington. October 7th is when we had major export controls come down on semiconductors. And so it'll be very important now looking forward to see how that U.S. policy response is shaped with existing controls and where those tighten up.
So we can talk about the export controls in a bit, but how did Apple get caught up in this? What do you think has motivated this move? If we take the reports at face value, is it about a tit for tat, given how the U.S. has cracked down on Chinese smartphone makers like Huawei, but also chip makers? Or is there something more given Apple's massive presence?
Well, we'll have to see what the formal Chinese directive ultimately says. Right now, there's just a lot of source reporting on this. But Apple has been in a pretty tenuous position in China so far. It's been a balancing act, you could say, where some 19% of their revenue comes from the China market. It's obviously very important. Apple has also been at the forefront of diversification efforts, for example, in expanding into manufacturing in India. And it's been trying to balance that with what it's been doing in the China market. Remember, Apple at one point was considering incorporating Chinese-made YMTC chips into Apple smartphones for the China market until U.S. regulators latched onto that. And then Apple backed away from that decision. And so there's already competition in the smartphone space when you look at Huawei, Oppo, Vivo, other Chinese smartphone makers. And this is also a quick policy measure by China to expand the market for those local Chinese chip makers and handset makers. And so this is obviously something that's going to undermine Apple's market share potentially in China. There is a question, though, of how far this spreads. There's a difference between a Chinese consumer and their personal preference for a smartphone, whether they'll continue to opt for the Apple iPhone, or whether they're this more nationalist push, of course, to get state agencies, state-owned companies to not use iPhones, will that bleed into more of the private consumer space or not?
Riva, what do you think the likely outcome is of that? Do you see it bleeding into the private consumer space? And also, how worried should other U.S. tech giants, other companies that have a significant exposure there to China, rely on China for their business? How worried should they be that they could be the next target?
So I'm a bit doubtful that we're, when it comes to the private consumer, of course, there are different priorities in mind. Nationalist sentiment only goes so far, and performance really matters here. And so, in this teardown, it was revealed that potentially SMIC, a major Chinese chip maker, produced a sub 10 nanometer chip, for the process node for this device. There were also memory chips allegedly coming from SK Micron, which are under investigation for that. So when we look at, the potential here for SMIC to be producing advanced chips for Huawei smartphones, there's a question of performance, efficiency, and then ultimately, what does that mean for the Chinese consumer? If it does end up being an inferior quality phone, I have doubts that Chinese consumers may still prefer the Huawei phone, but that's something to be tested over time in sales. As far as other companies, yes, this could be seen as a warning signal, and that you see a lot of Chinese policy measures that center on cybersecurity grounds in a broader national security context. Micron, you could see also as a related case in point.
The Biden administration has already responded to this latest Huawei phone and that teardown you've talked about from Tech Insights. National Security Advisor Jake Sullivan asking for a review to understand where the components came from. The backdrop to this is, of course, the U.S. had some of the tightest export controls in place, which is why Huawei hasn't been able to produce a 5G phone. What do you think the White House response will be? And ultimately, what does it say about just how effective the export controls have been in stifling the advancement of this type of technology in China?
And that's exactly the point. Huawei is among the most heavily sanctioned Chinese firms out there, right? This is where the U.S. foreign direct product rule was applied to Huawei. And so if there are advanced chips or inputs that are getting to the company, that actually gives the U.S. some political leverage to go back to foreign companies and their host governments and say what gives, right? So whether it's SK Hynix and the South Korean government, how did those chips get to Huawei? Or Netherlands when it comes to Dutch export controls on semiconductors and particularly on specific models of deep immersion, ultraviolet immersion lithography machines. What is that enough, to reach the intended consequences for export controls on Chinese semiconductor production? So this is where we're going to see a lot of conversation. I think again, a revival around partner alignment on export controls and tightening the technical parameters potentially on the October 7th thresholds. Not just where we're looking at how the U.S. draws the line on what constitutes an advanced process node for logic, but also for high performance compute capacity as well.
It'll be fascinating to see how all the pieces start to move yet again, even if we're just talking about smartphones here. Riva Gojan with the Rhodium Group. As always, thanks so much for joining us today.
Thank you.
Well, right after the break, the closing bell on Wall Street, we're going to check in on the latest market moves at the top and the top trending tickers. Stay tuned. We'll be right back.
And that's the closing bell on Wall Street. The Nasdaq ending in the red for the fourth day in a row. You're looking at losses of just about 0.9%. Lots of concern in the market just about the reports about China cracking down on Apple, potentially expanding a ban here on iPhone sales and exactly what are iPhone use and exactly what that means for future sales. We're seeing some of that concern ripple through the market. Also, stronger than expected econ data is also adding to some concern about what that means for the Fed and Fed future policy there on rates. This market check sponsored by Tasty Trade. The Dow, the only major average to close in the green today, up just about 57 points. Let's check in on some of those top trending tickers and starting with Apple. Apple closing the day off just about 3% down for a second day in a row. The Wall Street Journal yesterday reporting that Beijing is implementing an iPhone ban for government employees. And Bloomberg today saying that the ban could expand beyond government workers. Kiko, the question also now is how far that ban could potentially go. We were just speaking with Riva Gojan last hour saying that she doesn't think it's too likely that it will go as far as the private consumer. But we know China clearly very critical, very important to Apple. They get about a fifth of their revenue there from the country. So any sort of ban could have potentially broader implications there.
Yeah, and when you look at the sell-off today and also the declines we saw yesterday, certainly investors trying to get a grasp on what is actually the motive behind this, if in fact these reports are confirmed, and that's a big if. If it's just a ban for government employees and it is about sort of boosting the national champions like a Huawei, well, then you could argue, well, how significant is that impact going to be? Are consumers now going to start turning back to those Huawei phones? Well, that's a bigger concern because, as you mentioned, Shauna, China has been a big market, nearly 20% of their revenue coming from that specific market. At the same time, you know, you've got to ask questions about whether this is about national security because we've seen this tit for tat, especially in the tech space between the U.S. and China. Well, shares of C3AI down today after the company posted a deeper full-year loss than previously expected and pulled back from its original forecast to reach non-GAAP profitability by the end of fiscal 2024. The stock down more than 12%. Shauna, this kind of goes back to what we've been saying with so many of these companies. By the way, C3AI has the ticker AI, so you can see that it has seen the big run up when we saw the initial exuberance around AI early on in the year. But it is about the show me quarter. We keep saying that, and C3AI just not delivering on those numbers. And to add to that, the forecast not looking good.
Yeah, exactly, Kiko. It's certainly a show me quarter, a show me environment right now across the board for so many of these companies that have benefited from this massive run up, or the massive hype, I should say, surrounding AI since the start of the year. When you take a look at C3AI numbers, clearly not living up to those expectations. And there was some street reaction here from JP Morgan saying that they don't see top line metrics materially inflecting higher here at this point to justify the increased investment posture here. They're talking about the fact that C3AI plans to further their investments into this space, at least for now, and therefore obviously pushing off potential profitability here down the line. Now the stock here hitting a 3-month low. It had been up just about 180% prior to these results since the start of the year, but the company trying to adjust its business model, trying to prove to the street that some of these gains since the start of the year have been justified. But at least for today, on the heels of this report, and really ever since the company issued that warning about the coming quarters here, investors taking some issue with the gains in C3AI, and we're seeing some further downside risk there today. All right, let's also take a look at ChargePoint, another big mover here today, closing off just about 11%. Now, the provider of charging stations for EVs reporting worse than expected earnings results, also announcing a restructuring. ChargePoint saying that as part of its reorganization, it's going to cut about 10% of its workforce and reduce non-personnel costs. Kiko, it's a tough landscape right now, right? A smaller company, they need money, reliant on this funding in order to expand. It's a very tough environment to do that. And also competition within the space is heating up too.
Yeah, I mean, it's not, you know, a good look when we're talking about cuts when this is a space that is really trying to ramp up infrastructure. If we're talking strictly about charging or chargers that are in place, you look at the losses more than twice as bad as was expected. And of course, guidance also was not, also came in below Wall Street consensus. there's an interesting narrative that's happening within the charging space. And we've talked a lot about Tesla opening up its charging network, what that means for companies like ChargePoint. They have said, at least publicly, it's a good thing because more and more car companies or more consumers will adapt EVs and switch over. The range anxiety comes down. And yet here we are talking about those cuts. So certainly not a good look when you think about where this space is going, the growth that's expected, and ChargePoint being able to compete in what is expected to be a widely expanding market.
Yeah, certainly we're seeing losses just about 11% today. All right, tensions rising between the big three automakers and the United Auto Workers Union just days before their current contract expires. GM offering a 10% wage increase, but UAW President Sean Fain calling it, quote, insulting. Joining us now for more, we want to bring in Tom Narayan, RBC Capital Markets Global Autos lead equity analyst. Tom, it's good to see you. So both sides, it seems, remain extremely far apart. A strike more likely at this point, and what's the implications there?
Yeah, I think a strike is largely accepted and understood is going to happen. It's probably largely in numbers. I think what's really going to happen is you will have some work stoppage, probably similar to what we had in 2019. I think that one was about 6 weeks. Remember, 2024 is an election year, so the administration certainly doesn't want to carry this out too long. And we've done some math to show that actually, given how much labor costs are now as a percentage of total costs for the auto companies, it's a lot lower now than it was, let's say, 10 years ago. We actually think that higher elevated labor costs that may come out of this may not actually be as painful for the automakers as some may fear.
But what's the assumption when you say higher labor costs? There's a difference between a 10% and what the UAW is calling for, which is more than 40% hike.
Right. Yeah, it's a wide chasm in between the two. We actually did some math around this. A 10% increase really is only about 30 basis points of margin hit, which is really not all that much. A 20% hit is more like closer to 100 basis points, which is more meaningful, but still manageable. Now, is it going to be a 40% increase? That's obviously where one side wants. Or if you split the difference, you kind of get it to that maybe 10 to 20% increase, maybe a little higher than where the OEMs, Ford and GM, are asking for right now. But like I said before, that's about less than 100 basis points of margin hit. Totally manageable, especially the other thing to think about. If there is a strike, that means work stoppage. What does that mean? Less cars made, which means pricing can stay elevated. That offsets some of the labor costs, at least near term. So, all in all, if you split the difference between where the UAW is, where the OEMs are, you get to something like 10 to 20%. It's still manageable.
But Tom, is the demand, though, going to remain at higher prices? People are pulling back on some of their spending right now, some of their purchases. How big of a risk is that in this environment?
Yeah, that's a really good question. That, to me, is more important than what's happening at UAW. Demand so far is there. We've seen pricing hold, and the reason is you've had all the stimulus that came after the pandemic, right? What is it, like $4 trillion? And we're at the last trillion. And you've also had inventory levels are low. We've had 3 years of underproduction and underbuying. They are creeping up slowly, but right now there is support, believe it or not, for higher pricing. But the question is, to your point, what happens next year? What if interest rates stay elevated and don't come down? Then leasing a car is really expensive. So the threat, I think, is really more for next year, not for this year. But to me, the pricing coming down is a much bigger threat to the automakers than the impact of a UAW strike.
What happens to inventory levels if there is a worker stoppage? I mean, how much buffer do you think there is? Because, as we talked about before, Tom, we're talking about the big three in Detroit, which are unionized, but there are many other foreign car makers who are manufacturing in the U.S. who aren't subject to a strike that can potentially take advantage of this.
That's definitely a good point. But I mean, those three, Detroit three, really do dominate the market. Inventory levels are fairly low still. Based on historical levels, they've come up a little bit. But all in all, what are we talking about? I don't think it's going to be a very, very prolonged period. If it's 6 weeks, how much damage can foreign companies manufacturing in the U.S. really do? And as we saw, this was still the case in 2019 as well. We saw a quick snapback with the D3. It came back right away and made up a lot of that difference. Of course, you had the pandemic, and they got to put the pricing back up again. So yeah, I do see that as a potential threat. But if it's 6 weeks, I don't think as much damage can be done in that sense.
Tom, do you think it's going to delay the ramp up in production of EVs? And I guess how big of a risk is that then?
Yeah, that's possibly true. But as we've been hearing from the automakers in the US, there is this EV slowdown that's been happening. So maybe one offsets the other. One of the things that's causing that is EVs are priced really high right now. We're seeing a lot of benefits that are going to happen with the IRA. A lot of people don't realize how much money the government is transferring to US car buyers and also these OEMs. So, maybe it gives them some time to get these plants up and running to qualify for the IRA. And then you get the true benefit. And that's something in Europe, you don't get the benefit of the IRA. It's really these US OEMs. So yeah, maybe near term, there's a slowdown there, but I think it picks up down the road.
Tom, there's a larger question right now about what these car companies are going to look like at the end of this EV transition. And one of the big concerns that's been raised, especially by UAW workers, is that the process of making an EV. It's not as complicated. You don't have a gas engine. You don't need as many workers. I mean, what do you anticipate the head count to be? I mean, what does all of this transition to all electric ultimately mean for the scale of the companies we're talking about right now, the big three?
Yeah, that's a really good question. And I was the European auto analyst for 4 years before I came back to the US. And I would say over there, they had this problem already, right? Because they started a few years earlier. What they basically did is they moved folks from, let's say, a diesel engine plant and moved them into making power electronics for electric vehicle components. So I do think you'll see a reshifting and reshuffling of moving workers from ICE components to making EV components. They'll try to make people whole and try to keep the head count as high as possible. But to your point, look, there's less parts in an EV, right? Now, that said, the automakers are trying to get into making batteries. So that's a new business they weren't in at all, right? With these JVs they're doing. So maybe they can move some of the labor in that direction. So there's ways that they can kind of change where the labor is headed, maybe not doing what it used to make. But, all in, they're also talking about insourcing now, away from the suppliers. I think they'll try to find a way to keep folks employed. But yeah, down the road, maybe headcount comes down. That may just be unavoidable.
All right, well, a week to go until that deadline here to reach a deal in order to avoid a strike. We'll be watching. Tom Narayan of RBC, thanks.
Sure.
Coming up, what's better than knowing what's happening in the now, knowing what's next? We're going to preview what to expect from Yahoo Finance's new video series Next, debuting tomorrow. Stick around. More Yahoo Finance on the other side.
Now, from the Lower East Side to the heart of Seoul. For some men, I guess all the world is a catwalk. But why is our tech wizard Dan Howley strutting down one of the Korean capital's most famous shopping streets? Well, we're not going to tell you just yet. Find out on Yahoo Finance's Next.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is what's next with Samsung.
So you can put it in the water.
That's pretty gnarly.
Water.
This is the heart and soul of Astrobotic. This is where we build our landers up to go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet. We'll show you what tomorrow will look like today. Join us for our new series next.
That's right, we're very excited to announce that we are launching Next, a new original weekly series that will give you a glimpse at what the companies we cover every day are planning for the future and examine what that means for your investment portfolio. From smartphones and robots to space and electric vehicles, we're bringing you the stories that you'll be talking about tomorrow. And joining us along for the ride are Akiko Fujita and Prad Subramanian. Guys, how stoked are you to show everybody what we've been working on?
Well, yeah. Hey, Dan, how you doing, man? So, yeah, I mean, I'm really excited about what we can bring to the table from like a technological point of view, what we're seeing out there, what we think is the next in some sense. And I think that's a sort of a way for us to sort of show to our Yahoo Finance audience, like we're on top of that, but we're also talking about companies that you might be able to invest in the future as well.
Yeah, I mean, we're talking about emerging technologies, right, that will be sort of dominant in the future, but we want to talk about it right now. And over the last several months, we have been traveling, the three of us, out and about to try and find that next big technology. And Dan, it seems only natural that we're going to kick things off with you because you did travel the furthest in the summer heat in Asia to South Korea.
Yeah, I went to Seoul, South Korea to see what Samsung is up to. I gather you can probably figure that out from the promo with the giant Samsung sign. Basically going over their new foldable smartphones, the Galaxy Z Fold 5 and the Galaxy Z Flip 5. Does not roll off the tongue very easily. I said it so many times in our piece, and somehow my tongue is still tied. But it was a really fun time being able to just travel around Seoul. As you said, in the summer heat, I sweat like a maniac, and you can probably see that in the video as well. And we got to, experience where Samsung gets to build all of their things. I don't want to give too much away, but it was really fascinating to see how they put these new next generation devices together.
I've been on this train for 5 minutes, and I've already spotted 5 people with foldable phones, whether they're the Z Fold or the Z Flip. People are using them here a lot.
Yeah, that guy just wanted to hang out with me. I don't know what he said to me or if he was in the right state of mind. It was a little after 5 o'clock there. But yeah, I saw these foldable phones all over the city in Seoul and outside of Seoul as well. So, while I live in New York, I don't necessarily see them very often, but seeing them in person with so many people was totally wild to me.
Yeah, and Dan, in the context of what we've been following on the smartphone market, it's an interesting story because we've talked so much about how these upgrade cycles have gone longer and longer and longer. We're talking about incremental changes in smartphones where the camera gets better, but the device itself hasn't changed a lot. The foldable phone is the one thing where at least aesthetically it's changed. And I'm curious to watch your piece here to see how much of this you think other smartphone makers, Apple, of course, right in focus there, whether they in fact move towards this technology.
Yeah, Kiko, I used to have a flip phone. That was my first phone when I first had one, my Motorola StarTech. So I'm sort of anxious
this time.
See that phone come back. But Howley, I really loved how immersed you were in South Korea. The opening vignette of that package is so beautiful. Just seeing you kind of walk around, I believe it's Seoul, just so enwrapped in this whole new world that's so different than New York, but also sort of the same as well.
So we're going to kick things off with smartphones, with Dan's piece. But after that, we're really going to go out of this world. Yes, I couldn't resist. We're talking about the race to the moon. And you've probably been hearing about this a lot over the last several weeks, with India most recently becoming the 4th country to successfully land on the moon. on the South Pole, which is the darker side of the moon. But there's been an interesting race that's been happening within the private sector, commercial companies that have really been trying to get to the moon. And we had a chance to go inside Astrobotic. This is a Pittsburgh-based company that is trying to become the first commercial company to land a space lander on the moon. They have a launch coming up later this year. And I had a chance to go inside what's considered a clean room to get a rare close-up look at that particular lander. Take a look.
We all ready?
All right.
Astrobotic's ambitions are driven by CEO John Thornton. His lifelong vision taking shape inside a clean room so secure, few outside the company are allowed in.
That is the largest lander of any kind since Apollo.
So guys, plenty of comments out there you can make about my bunny suit and how big it was. But look, this is a multi-billion-dollar industry. And when you look at what's happening globally, what we don't know is that just 20% of that massive industry goes towards government agencies. So there is a huge opportunity that's out there. We know people like Elon Musk, other investors have been going in, but you certainly want to tune into that one because there is a massive race right now that's rapidly shifting to the moon in order to get to ultimately Mars.
Yeah, I think it's really cool that you actually got to go in and see what this lander looks like in person. I'm a big old space dork, and I like to see all of that. I watched the SpaceX launches, and I'm hopeful that we'll get to the moon someday. Whether or not that happens in our lifetime, they're saying so. Hopefully, these people can pull it off.
Yeah, I hope maybe they can sort of launch like a Hummer EV on that next Starship, and they can just use that as the next lunar rover.
Only Praz, you would think about it that way, right?
Yeah. But I mean, it's really cool tech, and it's sort of talking about with the future of transportation and mobility and sort of where we're going to be at if we're going to be doing, driving on interplanetary sort of terrain. We'll see. But, I got to say, Howley, you went to South Korea. Kiko, you went to a faux moon. Well, I can top all you guys. I went to Oshkosh, Wisconsin to check out Mercury Marine, which is part of the giant Brunswick Empire of boating. They invited us to Oshkosh. They have a test lake out there to see their Avator line of electric outboard motors, which is, in my opinion, going to be the future of boating. Check it out.
The transverse flux motor offers more torque in a lighter, smaller package than traditional motors. This allows for more power and portability for marine applications.
So what's it like to drive this thing?
Super easy, intuitive. What it really does is it really allows the user the ability to connect with nature.
Transverse flux motors, yeah, interesting stuff, but really quiet engines. I didn't catch any fish on that trip, but it was pretty cool zipping around on the lake with those electric motors. There's just no harshness compared to gas motors. It's really quiet and smooth. I really liked it a lot. I can't wait to go on a high power speedboat type of application.
Praz, there's a running joke within Yahoo Finance that you always find the best assignments going out on the water. Here's Dan going out to South Korea in the peak heat of the summer. I put on a bunny suit. You just went out on the water.
I was swarmed by lake flies.
EV
Lake
boat.
flies everywhere, in my nose, everywhere. I don't want to talk about it. South Korea, I'll take that any day of the week.
Not with the humidity. No, I'll take the lake. We'll switch next time.
All right, fine.
I guess, as we talk so much about EVs, though, I mean, what's the expectation here that, this is where it's going with boats, too? I mean, we've seen where it is with vehicles and passenger cars. What did you learn?
It seems like, at least initially, electric boating will be confined to small lakes, ponds, tender boats that take you from the shore to another bigger boat because of the fact that it requires so much power in the water and batteries are so expensive and heavy. But in the future, you might see lighter batteries, more power applications, and maybe even big ocean liners powered by electric power. We'll see.
Okay. I know you'll probably be there for every one of these launches, right? Just so you can get out on the water. Praz always with the push assignments.
I'll go for the private yacht.
Yeah, private yacht. That seems like a natural fit. Thanks to you guys, Dan, Howley, and Praz Supermania as well. But we really hope that you do tune in to these stories. We're going to be launching this new series again. It's next, debuting this Friday. We are going to kick things off with Dan's story in South Korea. We hope you'll all tune in for that. Chana?
I certainly will be. And of course, especially after the three promos by the three of you, I don't know. I think you guys all had pretty good assignments on this one. I don't think any of you guys are really holding the short end of the stick for that one. But we are very excited. And again, it all kicking off tomorrow right here on Yahoo Finance. Let's do a quick check of the market, sponsored by Tasty Trade, where all the trades closed for the day. Dow the only major average eking out gains, closing up just about 57 points. S&P and Nasdaq, though, closing in the red. You got the Nasdaq off nearly 1%. A lot of that because of the concern stemming from Apple, and that, of course, ripple effects across the tech sector. Tech, the worst performing sector in the S&P for today. All right, coming up, more from the Goldman Sachs Communacopia and Technology Conference in San Francisco. We are going to get a good look at the health of the consumer and also the trends within the buy now, pay later space. We'll hear from Max Levchin, CEO of Affirm. And that is not all. Brian Sazi is set to speak with Goldman Sachs CEO David Solomon. That's tomorrow at 3 p.m. Eastern Time. You won't want to miss that. We'll be right back.
Welcome back to Yahoo Finance's coverage of the Goldman Sachs Communacopia Conference. Tech media certainly on the docket all this week. Let's dive into all things tech with a little consumer angle with Max Levchin, co-founder and CEO of Affirm. Didn't we just do this last year?
We did.
We did.
Seems like 2 weeks ago.
I know, it really was. So big news out of your company today with Booking, and it seems like you're making a deeper push into the travel space. Why is that the case?
It's one of the few segments that's just keeps growing very, very well. There's just unbelievable demand for people to get out of town and shake off the pandemic.
Isn't this one way, using a firm to maybe just go out there and take a vacation if you don't have to upfront, thousands of dollars?
Exactly. That's a canonical Affirm use case. We're very good with things like t-shirts and shoes and smaller items, but if you're looking at that first big trip overseas and you haven't gotten out of town or country in a while, you kind of want to make sure it's great. And paying for it upfront can be quite expensive, and Affirm will help you get into one of those things without fees, typically without even too much interest.
How big a business is travel related as it pertains to Affirm?
It's a major segment for us. I don't think we disclose exactly just how big it is for us, but we definitely disclosed that at least a quarter ago, it was growing triple digits, which is quite impressive. Most recent quarter, it was still growing on that same sort of zip code. And so people are, even as the US economy, broadly speaking, is cooling, we can tell, travel is going very strong.
You have a phenomenal read on the health of consumers in this country, specifically middle income to lower income consumers. Yeah. What's your read on them right now?
Ask me again in 60 days and I'll really tell you.
I'm going to send you an email.
You should. Reason being, the student loan accruals just restarted a couple of days ago, and then the first bills are going to start coming in. We think it's not actually going to be a major thing for the U.S. economy. We know it's not going to be a major thing for us, but obviously we're very cautious. Credit is always job number one. That said, U.S. consumer has been unbelievably resilient. I think at this point, even Federal Reserve governors have come out and said, we're not quite sure why the standard rules don't exactly apply. And maybe it's the pandemic, maybe it's the fact that people just have to get out of town, but U.S. consumer has been pretty good about paying their bills on time and shopping and doing their best to push the economy forward.
As this increasing financial stress comes onto the consumer, how are they at paying their Affirm bill?
They are doing a great job, as a matter of fact. We just reported our quarterly earnings a couple of weeks ago, and we once again posted a sequential decline in delinquencies. So the measure of our financial performance relative to the consumer repayment is how good are they about being on time, and they're really good. They're better last quarter than they were the quarter before.
You think that's sustainable if now these consumers have to pay back their student debt?
For us, because we underwrite every transaction and because the typical term of a transaction is so short, it is not an output so much as an input. I think in the world of credit card issuance, when you're giving people lines a couple of years ago and they spend, and then suddenly times get tough and you got to pay your bills, that's when they start building up delinquencies. And you see that in the industry a couple of quarters ago, it started really accelerating. Ours did not. It is because every financial decision that we make, one, we keep credit in mind as job number one, but two, we ask, at this point, the models ask the question, can this person actually pay us back? And if the answer is we don't think so, we will decline them. And we have a lot of tools to say yes. For example, we can say, hey, you can be approved for a $600 travel ticket, but you can make a down payment and we'll finance 400 of it. So there's lots of ways to yes, but ultimately we do not issue loans when we don't think consumers can pay us back. And as a result, we have a lot better control over our delinquencies.
On the consumer front now, it is not the Affirm, Debit Plus card? Is it Affirm card? Affirm card. Any stats you can share on that?
So we flashed a whole bunch of really cool stats. If you look at our quarterly earnings supplement, you'll see what looks dangerously like a hockey stick curve of the active card growth. We announced that we had 300,000 active cards last quarter, and it's growing really, really well, very rapidly. It is a very cool product, so in my opinion, not a surprise to that people are latching onto it and having a great time with it. We are still in a super early innings. Obviously, our user base is in the millions, tens of millions. Affirm card is sub 1 million as of last quarter, but the growth is pretty extraordinary.
When do you open up that spigot? All these people are on your platform already. Why can't you just give them all cards?
In my experience, and I've had a few in financial services, you frequently regret opening up a unstoppable funnel of a new credit product. So we're going to be deliberate. We have opened it up. So the hockey stick very much documents our decision to say, we think this really works. It resonates, it's got a great product market fit, people love it. We get lots of very clear messages from consumers saying, this really clicked for me. I love it. It's better than my debit card. Debit Plus name meant that your debit card can't quite do all the things that ours can. Affirm card is maybe a better name, but it really is a debit card with unique features. You can swipe and just pay for things right now or pay for things over time on the same card, your decision in the app. So as we saw product market fit, as we saw the financial results that we wanted to see from the economics of the card, we've made it, generally speaking, open, but we have not yet told our consumers, you gotta get one. So it's available. If you're eligible, it'll just magically appear in your app as a thing you can say, hey, send me one of those things. I think in some point in the future, we'll definitely say you gotta have one of these things, and it will be available to the Affirm user base. We don't expect to market it, there'll be no CAC, but we got lots of people to offer it to.
Max, you're, I think I've told you this before, and if I haven't, I'll just say now, you're an OG in tech. I mean, it is, and it's always
I'm an O.
Okay, fair, but it's always special to get a few moments for you, and this is a special moment in tech with AI, and I've had 2 executives over 3 days tell me they are concerned about AI, artificial intelligence, what it might do to society. Do you share those concerns, and what are we up against the next decade?
So I think, like anything else, it is up to us to decide and act on what it can and cannot do. I think when humans invented first weapons, when humans invented the loom, when they invented machines, steam power, go back as any technological revolutions you can count, there were always people saying, oh my God, it's upon us, it's gonna take all the jobs, it might do terrible things to society. Generally speaking, it caused temporary and sometimes fairly long-term havoc where people were losing jobs and people had to be retrained, et cetera. And so all of that is very possible. And there will be people whose jobs will be made obsolete because AI will be better and cheaper. And so I think it's nothing to dismiss and not to laugh at. But I don't think we live in the world where it is a passive reality that the AI train is coming and we're not strapped to the rail. Like, it is an incredible collection of discoveries, inventions. It is a wonderful tool to make us more productive. Sam Altman, I think, says that it's like every one of us will have 1,000 personal assistants doing 1,000 things concurrently. That alone is a mind-boggling awesomeness that we should not dismiss or shy away or discount. And so I'm very bullish on AI. I think it's a collection of wonderful opportunities. I think probably more to the point, where does it accrete? It will initially at least really help companies with massive distribution and massive data to just amplify their offerings to create new value-added, lower cost opportunities for their products to evolve. I think maybe a bigger question is, if you're a startup, what do you do with all this AI bonanza out there? And if you look at the Y Combinator most recent class, I think 60% is building something in AI, so people are trying and making it up. But generally speaking, I'm very positive. I don't think we are so foolish as to allow the AI to turn us all into paper clips by saying, let's see what happens.
I still don't want to turn to paper clips. I remember you telling me that before. I don't want that. I have 15 seconds left. I know you're creating a firm. You work very hard. I always see you just busting your butt off. Do you want to play in AI in your next decade? I mean, not a firm. Do you see yourself creating another business? Do you want to be in that moment in a different way?
A firm is a very long-term project for me. I am quite committed to it, and I love what I'm doing. That said, we have a ton of really cool AI stuff that we're doing within a firm. 15 seconds is not nearly enough to explain it, but and we're pretty good at not saying too much before we launch something cool, but watch the space. We have AI ideas of our own.
All right, keep us posted. All right, Max Levchin, co-founder and CEO of a firm. Always great to see you. I appreciate it. And it's OG. It's not O, it's OG.
All right, I'll take it.
Guys, back to you.
Morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
and we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance. Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Brooke DePalma. We are breaking down some of our favorite trending stories from the day. Guys, I have my eyes on Tesla shares all day today. A big partnership with Hilton. They're going to be bringing those Tesla superchargers to Hilton. Over 20,000 chargers are going to be at different Hilton brands, and they're going to connect over 2,000 chargers, and you can install 20,000 chargers total. Interesting partnership when you think about what this means for Hilton. There you go. There's the full metrics. It's 2,000 hotels. It's 20,000 chargers, and you can charge up to 6 cars per hotel. And so it's going to be interesting to see how this plays out, I think, for what it means for Hilton, because I would think this helps you get people that drive Teslas to your hotel and is a benefit for Hilton as a business specifically. And that to me is part of what Elon Musk's pitch has been with these chargers is bring the chargers to your business and the people that drive my cars are going to come to your business more.
Right. And I think really what we're seeing here is Tesla play into providing their chargers in multiple different opportunities. A few weeks ago, we were talking about Tesla inventing a diner for people to crowd. And so really, I feel like Elon Musk has done a pretty interesting job at sort of creating a community around Tesla drivers and really inviting people now with this Hilton partnership, but really sort of a monopoly of sorts where they're attracted to go to places that have a Tesla. And we were talking about the specific charger that Tesla now has control over it. Honda in a few years will get access to the same type of charger. And really Tesla doing a great job here at creating themselves as a leader in the EV space.
Yeah, it seems like Tesla is making sure that its chargers are available to as many places as possible and really monopolizing that market. And I think the more the EV market matures, and you're already seeing so many of these car manufacturers lean into the EV boom, the more you're going to see this, not just at hotels, but also, you know, more superchargers maybe when you're driving on the highway. I think right now that's something that's lacking, but as more people adopt EVs, obviously you have government incentives as well. That's going to be more and more the norm.
My head just immediately went to rental cars. And I don't know if it's, I was online booking travel last night, so I was looking at rental cars and hotels and things like that, but I was like, think about that combo, right? If you can get a lot of rental cars, say deal with Hertz or something in a major city like New York, or even maybe in more of a driving city, go down to the Carolinas where you drive a little bit more in between places, but you have a relatively medium distance, you can charge the car at your hotel all the time. It just seems like it matches up well for the whole travel experience. And then if you're Tesla and you can find yourself in the middle of that travel experience, would think you'd be pretty beneficial. But I don't know, I guess I'm extrapolating a little bit.
Right. So while we're thinking about traveling, there's another thing that fans might travel for because the NFL season is back. And while many are looking forward to the big game, I have my eye on something else. Beer brands. One marketing expert calling it a beer battle. As you can see right here, Bud Light making a big splash with their new commercial. It's called Easy to Sunday. And essentially what they're looking to do here is regain the market share that the company has lost. As you can see here, different fans are playing into this. They're really highlighting that nostalgia factor, that emotion around what it means to be an NFL fan. Once again, Bud Light really looking to make a splash here. They are still a sponsor.
Look, one thing that stands out to me here, they're sort of getting at what Bud Light has been for the NFL, right? Like when you go to an NFL tailgate, at least from my experience, you expect there to be Bud Light in the coolers and people to be drinking Bud Lights. They've had those cans throughout the years that have the team logos on them. Everyone loves going to, you know, maybe a New England Patriots game in Foxborough and you get a nice New England Patriots Bud Light can.
Personal experience?
Just an example of cans that they have in the
field,
or maybe that you get an Eagles can and screens, cool. But I wonder what tailgates are going to look like this year, right? I feel like that's a great, simple sample size of what people that used to drink Bud Light, that target market, is drinking, especially in group culture too. One person goes and buys the beer, right? Or buys a lot of the beer. One person goes and buys a big pack of 30 beers for a group of people. If they make that choice to not buy Bud Light and they can't keep that market share,
it's going to be interesting to see how it plays out during football season.
And Josh, I do want to point to the numbers on the screen. As you can see, Bud Light sales continue to struggle, where Miller's, Coors Light, Miller Lite continue to perform well. Molson Coors certainly benefiting from the sales decline that Anheuser-Busch has received. Molson Coors brand continue to perform well, and Molson Coors actually looking to keep that market share. They're investing $100 million throughout the rest of 2023, a big number there. And they also have a commercial coming out this fall. They're also going to have a secondary commercial around college fans. As you can see right here, they're focusing on exactly what you were just saying, that tailgate season that people look to go for beers. And so really what we're seeing here is a paradigm, really Bud Light looking to regain, Molson looking to hold on to the market share that we're seeing, and multiple professors that I spoke to, they're just saying that this is something that they're going to watch, and they're expecting Bud Light to spend more than they ever have before.
But will it work, especially for those that have given up on Bud Light, have moved on? I just wonder how effective ad campaigns like this is.
It's interesting, though, you mentioned how much they're going to spend, Brooke. It does feel like an essential fall if you're Bud Light, right? You really didn't gain back that market share in the summer around key holidays like Memorial Day, 4th of July, Labor Day.
This is probably the last
If you can't win back the beer bucket at the bar
Yeah.
and the beers in the tailgate scene, it's never coming back. Like you got these couple months to get back those traditional light beer drinkers, and if you don't get it back this fall, then when is it coming at this point? We're passing a lot of major milestones.
I was going to say, some professors are optimistic that eventually they'll regain some share, but it's not looking too good right now.
Yeah, well, maybe one place that you'll see more beer drinkers is weddings. You know, you get a beer, you get a glass of wine. Who knows? I don't go for beer at wines, but at weddings, I go for, a nice wine, maybe a glass of champagne. I'm actually going to a wedding this weekend, but there was an article out about how expensive it is to go and be a guest at a lot of these weddings. I've already have 4 this year. I have 2 lined up for next year. I'm 30. I'm in that prime age when a lot of people are having weddings. And interestingly, The Knot had a study out that say guests that travel by car to a wedding spend an average of $640. Guests traveling by plane celebrate $1,200. And that doesn't even include bachelorettes, bachelor parties, bridal showers, if you're invited to those. So these costs can really add up, and it's becoming quite a headache for those in their 20s and 30s, especially at a time where, the student loan payments are restarting again, inflation.
This is real concern, Josh.
It is a real concern.
But it's expensive.
We were talking about how expensive weddings are, and then the student loan, I get it.
I'm just saying.
It's weighing on people's wallets.
It is.
There's a lot of different spending for this demographic in particular.
And now take into consideration gas prices to get to that wedding. If you're in the city, you
Fuel
don't have a car, you need to rent a
airlines
car
are
to
going
get
up.
there. Exactly. Airlines are growing up. And I personally have had 5 weddings, and it puts you in such a hard spot because you're so excited to celebrate your friends.
Yes.
You're so excited to be invited, but then you're like, oh my God, this is going to be a lot of money.
And then what's the etiquette too? It's
Yeah.
like there's always that question of, do I spend more on a closer friend? But then you sort of set a precedent, and people write and track all this stuff down. So eventually you're just swapping the same amount of money.
Exactly.
That's what I was going to say. I think the gifts are the problem, right?
Ooh, the problem?
Well,
I do cash at a wedding.
Yeah,
I don't.
cash
No, but I mean
Register for the bridal shower, cash.
setting you back as far as financial, you can't really get around the travel to some extent, right?
Yeah.
You can't control where your friend lives.
Do you give less
money
of
is
a
the
gift
only
if it's a travel wedding?
Probably,
would you
right?
give less if you're
No, that is the
flying to
question.
be there?
But
then
you
what's the standard?
don't, which is why everyone ends up feeling bad about it and being annoyed.
Yeah.
But I think that's my point is I wonder if we'll get to some level there as it seems like bachelor and bachelorette parties are getting crazier and crazier too.
Oh, yes.
So as those continue to get crazier, at some point, where does the cost cut back, right?
Yeah. I actually read something interesting, and they say that Gen Z expects to spend the most on attending weddings, of course, followed by millennials, Gen X, and baby boomers. But I feel like there's sort of this expectation around young consumers, how much they're willing to spend or how much they should be spending on their friends when they think about these what are getting more and more elaborate bachelorette vacations.
I blame Instagram, TikTok for that.
100%.
You just want to show off and be the best.
Yeah.
As a Gen Z, I don't expect that. All my friends out there, please don't do that. You got to get in with the friend group.
You're a simple guy.
You got to get the friend group to agree. Let's all do some nice local cheap weddings, cheap bachelor
You're
parties.
from Massachusetts. You're going to at least there.
Yeah, right.
It costs you a lot of
Keep it
money.
low cost.
All right, he's saving money. Brooke and I are spending money. We'll have more on the other side of this break, though. A recap of the news today and what's coming up tomorrow. Stay tuned to Yahoo Finance.
Let's take a look at two stocks trending after hours, DocuSign and RH. First, starting with DocuSign, up just about 3% here in extended trading. We're looking at a pretty strong report here from the company. DocuSign raising its full year revenue forecast, beating on both the top and bottom lines. The company also expanding its buyback program by $300 million to a total of $500 million. These solid results here, despite the pullback that we've seen in spending from medium and small sized businesses. And taking a look at the chart, if we're able to pull it up, DocuSign here has been on an okay run over the last couple of months. And taking a look at a 3-month chart, you're actually looking at losses of just about 8%. Now, we did see a bit of a run up here into this report. On 1 month, you're looking at just about 1%, so more of a steady climb here over the last week or two. And also taking a look at RH, the company there reporting results that obviously the street is taking issue with. The shares off almost 9% here in extended trading. Revenue and earnings did beat, but what the street is taking issue with is its guidance and some of the commentary in this shareholder letter from the CEO, saying that many of the challenges with the broader economy, he sees that remaining to be the case here for the remainder of this year and also into 2024. He talked about the highest mortgage rate that we've seen in just about 20 years, with rates remaining above 7%. He sees that as a headwind here for the company. Now, RH is up just about 37% over the last 3 months. Year to date, we're looking at pretty much a similar gain here, so well off the lows that we saw earlier this year, right around May. So again, a strong report from DocuSign, but RH, some weakness there. We're seeing that stock move to the downside in extended trading.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. The concerns about the reported Apple iPhone ban in China now reverberating to the tech giant's suppliers. Qualcomm shares sliding nearly 8%. It is one of Apple's biggest vendors supplying the modem chip. In the last 2 days, Apple has lost $200 billion in market value on reports of that ban being expanded. Well, Disney amending its federal lawsuit against Florida Governor Ron DeSantis. The suit now focuses only on the First Amendment claim that DeSantis retaliated against the company over its criticism of that controversial Don't Say Gay law, which bans classroom lessons on sexual orientation and gender identity. The other claims in the case were tied to the dispute over Walt Disney World's development contract. That's being pursued in a separate state-level lawsuit in Florida.
Well, here's what to watch tomorrow. We are going to hear from San Francisco Fed President Mary Daly on the back of a surprise drop in jobless claims. Investors will be listening for any clues on future policy decisions ahead of the next Fed meeting in just about 2 weeks. Plus, earnings season still going strong. Kroger is set to report before the bell. The street will be looking for any update on his deal with Albertsons. We're also going to hear from Rent the Runway. The company added subscribers last quarter. It also said that it got a bit closer to profitability. And we will head back out to the 2023 Goldman Sachs Communacopia and Technology Conference. Brian Sazi catching up with Goldman Sachs CEO David Solomon. That's tomorrow, 3 p.m. Eastern Time. We're also going to be launching Yahoo Finance's Next, a new original series that will give you a glimpse at what the companies we cover every day are planning for the future and examine what that means for your investment portfolio. Stay tuned for that debut tomorrow, Friday at 10 a.m. Eastern Time. That does it for us today on Yahoo Finance. I'll see you right back here tomorrow. Have a great night.